Okay, I'm going to walk through number 63 for you. So again, you'll have the Excel worksheet out in Blackboard, but I'll go through the steps. Not necessarily, again, the steps that they ask us to in the book, but the steps that I feel like you really need to do in the background. So we've got a parent company acquires 80% interest in the sub. And then they give us the equity stuff. We'll get back to that later. There's no acquisition accounting premium, assets, or goodwill. Then we come over and it tells us that on December 31st, 2010, the parent company issues bonds for $400,000 face value, 6% 5-year bonds to an unaffiliated company for $426,340. So they're issued at a $26,340 premium. It tells us that that's amortized over straight line at $5,268 per year. Then 2 years later, December 31st, 2012, the subsidiary paid $389,503 to acquire all of those bonds. So then the subsidiary bought them at a discount. And then they're going to amortize their discount. Remember, though, when it's in the investment side, we don't actually have a separate discount account. But they're going to amortize that at $3,499 a year. So that's where we will start. So I've decided to set it up in Excel. I think that might be easier than trying to use that whiteboard. So what we want to do, though, is say, okay, the parent's entry, the day that they the day that they sell the stock or the bonds, they are going to receive cash for the 426,340. Let's see, I can make that. Okay, then they are going to set up the bonds payable. Okay, then they're going to set up the bonds payable at the $400,000 face value. And then they're going to record a premium on that bond. Okay, so those would be their entries. Then at year end, their interest accrual entry, which would be every year end as long as they have these bonds, because again, it's straight line, so it's not going to change. They're going to have interest expense. They're going to amortize that premium. So we set it up as a credit to amortize it. We're going to debit it, and then we're going to credit cash. Now the cash is the easiest one to figure out because they're $400,000 bonds at 6%. So if we take 400,000 times 0.06, that gives us $24,000, and they'll always pay that in cash. The premium amortization, you could really take this 26,340 and divide it by the 5 years, but they already tell us what it is. So we will go with what they tell us, and what they tell us is 5,268. Okay, so then our interest expense is the net of those, what we need to make it balance. So it'd be the 24,000 minus 5,268, or 18,732. Okay, then we're going to come down and say on December 31st, 2012, kind of map out what happened. So the purchase price that the sub paid was $389,503. If we compare that to our net book value of the bonds, so we would have bonds payable at $400,000, and then we'd have our unamortized premium. So our unamortized premium, well, it would also, we'll subtract that out. It's going to be the 26,340 plus, or how about I put it in parentheses? So the 26,340 minus 5,268 minus 5,268. So 2 years of amortization. Let's see if that worked out right. And that does. So the unamortized premium is $15,804. So then now if we subtotal those, or sum those, I should say, that gives us our gain. So that's our gain on the debt extinguishment or retirement, however you want to word that. Okay, so we do kind of need to know that because that does impact us. If we were doing an entry for 2012, we would actually credit gain. But if you look back at the problem, we're in 2013. So that's a year later. Okay, then we're going to come down. So maybe I'm going to kind of like square this. Whoops. Square this so I can kind of go back to it. So I'm going to box that in just so we can kind of look back at it. Okay, so then if I go down now and say, okay, now my subs entry. So the sub entry, again, they paid the $389,500, so they would have a bond investment. And then they would credit cash. Okay, then their year-end entry, again, it's straight line amortization, so it's going to be all the same. They're going to receive the cash, and if I look back up, it's going to be the same amount that the parent is paying because they bought 100% of it. So they're going to receive $24,000. They're going to amortize the discount by debiting the bond investment. Again, the goal is to bring this bond investment here over time up to $400,000, which is the amount of the face value of the bonds. And they tell us that discount is being amortized at $3,499 a year. So that goes there. Then the credit goes to interest income. Whoops, wrong cell. Okay, so come down here. The credit goes to interest income. For $27,499. Okay, so then we'll also come back to these entries also. So again, we'll look at our parents and then we'll look at our subs, and then we've got the total in the middle. Okay, so then if we want to, I'm going to just kind of maybe scooch you over here. Maybe not, maybe I'll go down to the bottom. All right, so if we go down to the bottom and we say, okay, now let's look at back into our equity income reconciliation. I start with the subs net income, and if I pull that right off of their income statement, it's $147,499. Well, because these are the parents' bonds, the NCI has no interest in them. So we're going to do our split right away. So we say, okay, if I come down here, $147,499 times 0.8 gives me my parents, and then I'm going to round it to the nearest dollar. Get rid of those cents. Darn it. Get rid of those cents. Okay. Then if we come down here and say, okay, then if we take the 147,499 times 0.2, and again, we're going to round that to the nearest cent. Okay, so then this is our NCI income. And then this is the parents, but that now we still have to make adjustments to it. So then we go back up and say, okay, in that parents' net income, there is interest income of $27,499, which is right there. So I want to subtract that out. And then there's interest expense of $18,732, and I want to add that back. And then I'll sum those, and that should be what shows as my equity income. Okay, and it does. So with 109,232, just in case you're trying to back into that, you just have to make sure you do the split first. So that's kind of the key there. So we're going to split first. Okay. All right, then I'm not going to worry about the equity investment because there's not that much entries into it. So now if I go back over, and I'm just going to maybe kind of go over to the side here to keep it all on one worksheet. I've got my E entry. So my E entry, I'm going to set it up to debit my common stock, debit my paid-in capital, and then debit my beginning of the year retained earnings. And then my credit goes to the equity investment at 80%. So 436,000 is what that is. Or you could say, if you want to do it more mathematically, say, okay, I'm going to sum these and then multiply that times 80%. Okay, then the remaining 10% goes to the NCI. And again, if you want to say, I'm going to sum these and then multiply that times 20%. And let me make these in dollars and cents. Okay. So that's your E entry. Then we're going to come down to the C entry. And then our C entry is kind of what I mapped out down below. Maybe I'll actually just do it down below. I'll kind of do these a little bit out of order. I'm going to come down here and say, okay, my C entry is going to be out of this stuff. So it's my C. I'm going to debit my equity income for the $109,232. I'm going to debit the net income that's attributable to the NCI for $29,500. I'm going to credit my dividends. Now that I have to go back to the problem, but it tells us that the total dividends are $20,000. Then I'm going to credit my equity investment. And that is going to be for the $109,232 minus $16,000. And my $16,000 is 80% of those dividends. Then same thing with the NCI. I'm going to say, okay, they get $29,500 minus $4,000 because that is 20% of those dividends. And then that should be our entry for the C entry. Okay, now I'm going to come back up to this middle section and do the bonds because that's probably the entries that you're really kind of struggling with. So I do them in two entries. So I think I call them both the I bond because you could sum them together like the textbook does. But what I do is I take and look at it to say, okay, the parent on their books has this bonds payable of $400,000. I need to eliminate it completely, and I need to eliminate the unamortized bond premium. But at my beginning of the year balance, so I'm going to debit my bonds payable for $400,000. I'm going to debit my premium. Now I'm not going to go back up to this value here because that was the start. I'm going to look down here in my little box. My unamortized premium is $15,804. Then I'm going to credit my bond investment. If I look down at what my sub has on their books, they have $389,503. So I've got to come up here and eliminate that. Whoops. Okay, then in order to make this balance, if this were the year of the sale, I would want to put in the gain, which is what I started to type, but it's not the year of the sale. So every year thereafter, it's going to be tied up in the equity investment account. So then the equity investment is going to have $26,301 that needs to be credited out of that. And then that should make that entry balance. Okay, then that's my first entry. Then I come down and you'll see a lot of these accounts are the same though, which is why the book puts them together. Now I look at the year-end entries and say, okay, now I got to deal with this interest expense and this interest income. So I start there to say, well, I need to take the interest income off of my books. So that's going to be my first debit. I'm going to skip a few lines. And then I know that I've got to take the interest expense off of the books, and that's going to be my last credit. So I can go ahead and fill those in. So I know I'm going to credit interest expense $18,372, And then I've got this interest income of $27,499. So I come up there and I debit that. Then what's in the middle though is what I do, because again, it just seems easier to me. I reverse these entries. So if this year-end entry is a debit to bond investment, I'm going to credit it. For that 3,499. Whoops. And then if I look up at the year-end entry for the parent, they're debiting their premium for 5268. So now I'm going to credit that. Oh, whoops. These should be in the credit, so we'll put them over there. And then the same with the premium. The premium's also going to be credited for the 5268. And then my entry should balance. Now, again, what the textbook is going to do is they're going to take all of these right here and combine them into one entry, because you can see, you know, you've got the premium and you've got the bond investment, you've got the premium and you've got the bond investment. You could net those. So if that's what you want to do, you can do that. And that's a lot of times how the publisher is going to, if you look at the solutions, there you'll see it that way. But I think it's easier to break them out like that. So that is kind of my advice. So now take this and then take that over into the consolidating entry and you should be all set.